up now. I don't want my bank changing the terms. I don't want material average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards, they stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, it's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened. They didn't look at the forward indicators I described, and they found out too late. Then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018, less than 3 months. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped. I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened. They tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets, and that's the key word. It's not if stocks are going down, but it's kind of a little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing.
But real quick, I guess, let's stick on the recession just for 1 second, because there's the, bad recessions generally come along with a lot of job losses. Do you see, given that this recession could be worse than most are expecting right now, there being, wide-scale layoffs of the sort we've seen in some of the bad previous recessions, like '08, like '01?
The answer is yes. First of all, we're seeing it already. So, I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come It hasn't shown up in the unemployment numbers because the unemployment rate is it's around 3.5, 3.6 on the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This isn't like, oh, a good year or a good day. This is the lowest since the 1960s. And the Fed is absolutely looking at that. You're right about that, Adam. And they're saying, and of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. It's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. They say you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights. Find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, oh, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So and then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. We know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%, so your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake. But you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because it runs around 5% annualized, give or take. Sounds like, hey, 5% raise, what do you want? Well, yeah, but with 8-9% inflation or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61%, 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And it has come down ever since, and it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree.
Right. You're in the military. Yeah.
You're in the There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's a depression level of unemployment. It's going up. It's going up a lot. And let me just back that up a little bit because that's easy to say. I don't say things like that without a lot of analysis. There are three different ways to think about it. One is just some technical analysis. This is the third great bull market in gold in history. And when I say history, I'm only going back to 1971 because prior to 1971, gold was money. So you didn't have a bull market or a bear market. It was fixed to the dollar. The people who bang the table and say, give me a gold standard. I'm like, well, be careful what you wish for, because in a gold standard, you're not going to make any money on gold because it's fixed, it's pegged to the dollar. If you want to make money on gold, you would actually be against a gold standard because they keep screwing up the currency and the gold goes up. But we had a bull market from 1971 to 1980, and gold went up 2,700%. Then we had a bear market from 1980 to 1999, and gold went down from $800 to $250. So that's, and do the math, that's 60 or 70%. Then we had the second great bull market from 1999 to 2011, and gold went up 670%. Then we had a bear market. It's funny how these things go in cycles from 2011 to 2015, but you can call the bottom. It was December 16th, 2015. Gold was $1,050 an ounce. I'm talking US dollars. That was the bottom. And I saw it at the time, and I called it at the time based on a conversation I had with Jim Rogers, who's the greatest commodities trader in history. And we were down in the Dominican Republic at Casa de Campo during the bear market. And I said, Jim, what do you think about gold? He goes, well, I own it, but I'm not buying more at the moment. I'm waiting. He said, I'm not selling it, but I'm not buying more. I'm waiting. And he said to me something that just hit me right between the eyes. He said, gold is going to the moon, but no commodity goes to the moon without a 50% retracement along the way. There comes a time when it drops 50%, and then it's like the second liftoff, and then it goes to the moon. Now, take the bottom in 1999, it was $250 an ounce. The top was $1,900 an ounce in August 2011. So that's $1,750. Half of that, so 50% retracement would be down $825. So 1,900 minus 825 puts you at 1075. Well, bingo, 1050. That's close enough for government work, as we say. So when I saw 1050, I talked to Jim Rogers about this earlier. When I saw 1050, I said, okay, there's your 50% retracement. Using 250 you have to have a base. Using 250 as your baseline, up to 1900, take that gap, down 50%, boom, 1075, we were 1050. I said, that's the low. Now it's getting close to 1900 again. I mean, actually, on an intraday basis, I think it just kind of kissed the all-time high. It was like right there. So there's the full retracement of the bear market, but this bull market, the third great bull market, started December 2015. We are up almost 90%. You go from 1050 to 1900, that's about 90%, 86, 87%. But bear in mind, the last two bull markets, remember what I said, 2,700% and 670%. So 85% is great, but when you get into like 600, 700, 800%, or 2,000%, you're talking about $15,000 by 2025. So if we just did the average of the two prior bull markets, I'm not even talking about the higher of the two. Take the two bull markets, average the duration and the gain, and then apply it to December 2015. You get to the exact number is $15,000 by 2025, $15,000 an ounce by 2025. But people go, that's 4 years away. It's like 5 years away. I was like, yeah, but to get to from 2,000 to 15,000, you got to go 3,000, 4,000, 5,000, 6,000. You can make a ton of money. So that's where it's going. Now, could it go down tomorrow? Sure. I mean, the gold's volatile. I don't get too hung up on it because I'm kind of a buy and hold person. You know, I don't get too euphoric when it goes up, but I don't get depressed when it goes down. In fact, when it goes down, I like to see it go up for our listeners and our readers. But personally, I don't mind when it goes down because you can buy more at a cheaper price. Because I know it's going up. I know where it's going. So the answer is, and just a little, again, sixth grade math is usually sufficient. When you get to higher levels, a fixed dollar increase is a smaller percentage increase. So people go, oh, it went from 1800 to 1900, it went to 2000, 2100, and that's a big deal and good for all of us. But those $100 increments get to be more and more frequent and more common because they start looking like 1/2 of 1%. 1/2 of 1% is not a big deal in the market. So you're going to see that on a daily basis. So my advice to people, of course, is buy gold. But I said that at 1100, 1200, 1300, 1400, 1500, 1600. You know, I've said it all along, and people don't buy it. People also accuse me. They say, "Well, Jim, you're just talking your position. You know, you're just trying to sell gold." I'm not a dealer. I don't make any money. If you buy gold, good for you. But I'm not in the business. I'm a writer. I'm an analyst, but I'm not a gold dealer. I'm actually one of the few analysts, apart from yourself and a few others, who are not gold dealers. But I think that gives you more credibility because you're not selling gold, you're understanding gold. But for anyone who hasn't bought it yet, of course, denial is a powerful thing. They'll say, well, I missed the boat. Now it's up this high, it's going to go down. You haven't missed the boat. I mean, again, 90% is a good run, but this is going to go multiples of that.
All right, let's dive a bit deeper into what we've covered about gold. So, we've been seeing gold prices going up quite a bit lately, and there are a few factors behind this trend that we can break down. Firstly, when we look back at the history of gold prices since 1971, we can identify 3 major periods where gold prices surged. These periods are often referred to as bull markets, and they're characterized by sustained increases in the price of gold. The most recent bull market began in 2015 when gold prices were relatively low. Since then, we've witnessed a significant uptrend, with gold prices rising by almost 90%. However, if we compare this current increase to the previous bull markets, it might seem a bit modest. For instance, in the past, we've seen gold prices skyrocket by 2,700% and 670%, making the current surge seem comparatively smaller. Now, looking ahead to the future, some experts are making bold predictions about where gold prices could be headed. There's talk of gold reaching a staggering $15,000 per ounce by 2025. That's a substantial jump from where prices stand today. But, of course, we have to consider that the path to that price level may not be smooth sailing. Gold prices can be quite volatile, meaning they can experience significant fluctuations in the short term. Despite this volatility, many investors still view gold as a valuable asset to have in their portfolios. That's because gold has a reputation for holding its value over time, especially when other investments might be struggling. So, if you're thinking about adding gold to your investment mix, it could be worth considering for the long term. In essence, the story of gold is one of resilience and opportunity. While we can't predict exactly where gold prices will go in the future, understanding the historical trends and current market dynamics can provide valuable insights for investors looking to navigate the world of commodities trading.
The U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you had a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like they spent the savings they had, they didn't make new savings, and then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and we'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25, 20, 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards, and they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another. That sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy, defense, not for good reasons. There's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up. I get it. But it looks like they peaked and have turned around. So Treasury notes, a 2-year note, a 5-year note, will perform very well, and they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term Treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. The interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. And 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for a 6-month Treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is Well, yeah, Jim, that sounds good. But if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So, yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to lose, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. And what it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is the longer the maturity, the more they go up. They're more volatile. And so 2-year notes are a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I don't. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too. But the bigger question is, why on earth is the Fed raising rates when the U.S. economy is on the brink of recession? When the U.S. economy is hanging by a thread, you don't raise rates in a weak environment. You raise rates when, the economy's hot, unemployment's, lower than it is, but inflation is taking off. Things look speculative, and then you raise rates to cool it down a little bit, and then when the market cools down, unemployment goes up, inflation falls, then you ease, then you cut rates. And the Fed never leads the markets. The Fed always follows the markets. The Fed's always working with a lag. So why on earth are they raising rates in a difficult, challenging economic environment? And the answer is they're doing it for the wrong reasons. They are desperately trying to raise rates so they can cut them in the next recession.
Yeah.
The history is that you need to cut rates 300 or 400 basis points, 3 or 4%, in other words, to get the U.S. out of a recession. And typically the way it works is you go into a recession at, 6.5% interest rates. You cut them 3% down to 3.5%, maybe a little more. And then that's enough to get the economy out of the recession. Well, how do you cut 300 basis points when you're only at 25 basis points? Well, you can't, obviously. They're trying to raise rates so they can cut them. I say this is like hitting yourself in the head with a hammer because it feels good when you stop. But the Fed's conundrum is, how do you raise rates enough so that you can cut them in the next recession without causing the recession you're trying to prevent? That's the conundrum. And I think the answer is you can't do it. They're going to cause the recession. The Fed is not neutral when it comes to raising rates. They are biased in favor of raising rates. So it's not the case. When they wake up in the morning, they're not asking themselves, do I want to raise rates? Do I not want to raise rates? What's the data dependent, all this stuff. They wake up and say, I want to raise rates. Can I? In other words, just because they want to raise rates doesn't mean the coast is clear. So I analogize this to a little kid who's trying to steal money from mom's wallet. If mom's looking, they won't take it. But if mom's out in the backyard, they'll go grab some money. So the Fed will raise rates whenever they think they can get away with it. So they want to raise rates. They can't always raise rates if they think things are iffy or the markets don't expect it or financial conditions are already too tight for other reasons. They won't do it. But if the coast is clear, they will. when you throw out a phrase like world taxation, we talked a little bit earlier about world money, the SDR, and the initial reaction on the part of some readers is to roll their eyes and go, well, there goes Jim again with all his crazy conspiracy theories. But these are not conspiracy theories. Again, I make the point. This is very, very important. This is all documented. This is all happening. You can go to these websites. You can attend these meetings. You can look at these working papers. It's all real. Now, as far as world taxation are concerned, we said earlier they love these crazy acronyms that no one understands unless you're expert on all this. But the key phrase here is BEPS, BEPS. That stands for base erosion and profit shifting. So base erosion and profit shifting are the bad things that corporations do to get out of paying taxes. And the governments are going to lead an attack on BEPS, attack on base erosion and profit shifting. And this is all being directed by the G20. And of course, the G20 is this world leadership. It's basically the board of directors of the world. That's the easiest way to describe it. The G20 operates like a board of directors, but they don't have a big staff and directorate. But what they do is they farm out these projects to different existing agencies. It could be the United Nations, it could be the IMF, but we have another group called the OECD, Organization of Economic Cooperation and Development, based in Paris. This is a kind of a rich country's think tank, and the G20 have given the OECD the task of coordinating and implementing BEPS, the BEPS project. And the way it works is, let's say you have an invention, but you invented it in the United States. Well, if you patent that invention and license it for royalties, and all those royalties come to the United States, you're going to pay U.S. tax on it. But what if you take the invention and contribute the intellectual property to an offshore company, and then that company then does all the global licensing? And now all the licensing fees go into Dublin instead of Seattle, and you're not paying any tax there because you got a special deal with the Irish government. Well, that's the kind of thing that's going on. Many, many more complicated examples than that, but that's a simple one that makes the point. The other thing that's done is you mess around with debt equity ratios. So I've got an offshore subsidiary, and instead of giving a capital, I borrow a gazillion dollars from it and pay them interest. Well, what's happening with the interest? Well, it's a deduction in the U.S., and it's income in, say the Bahamas, right? So I get a nice fat tax deduction in the U.S. The money goes to a tax-free jurisdiction like the Bahamas, but I'm just taking it out of one pocket, putting it in the other, right? Because I own both companies, and the corporations are moving this money around so fast that nobody can keep track. So what the governments have decided to do is join forces, and they're going to create this global tax network. And they're going to say to every major corporation, you're going to have a global tax ID, not just your Social Security number, the corporate equivalent. You're going to have a global tax ID, and all of your subsidiaries are going to have IDs, and all of your transactions are going to have IDs. And all this information is going to be reported to a database to whatever country has jurisdiction. But then all the countries are going to share all the data using this unified ID system and then put it into one giant supercomputer and that everybody can access. So now all of a sudden, Germany's going to be able to see the other side of the trade. They may know that a German corporation is paying interest, but they'll be able to learn that the interest is going to an affiliate in Hong Kong that's not paying any taxes, et cetera. So they're going to have the complete picture. And then once you have the picture, you can attack it. You can use, anti-avoidance provisions. You can use special laws and, Section 269 of the Internal Revenue Code. I mean, they're equivalents all over the world. They have the tools, but what they don't have is the information. Well, under this BEPS project, they're going to get the information. And then they're going to combine the information and the tools, and then they're going to tax these corporations. And they'll be able to run, but they won't be able to hide. And then they're going to raise the rates. And then a lot of people say, well, what's wrong with that? Why shouldn't they pay their fair share? And my answer is, you should pay your fair share. But what's fair? So this is a full-scale assault on the ability of corporations to legally avoid taxes, but it's going to segue into something that's much more punitive, much more extractive. But when you look at interest rates, you have to distinguish between nominal rates and real rates. Now, I'll give you an example. In 1980, I got my first mortgage on a condo in New York, and I paid 13%. And my mother cried. I mean, her first mortgage was like 3%. And here I am paying 13% on mortgage. My mother was all upset. She thought that was like a dumb decision. But I said, Mom, I'm paying 13% interest, but inflation is 15%, and taxes are 50%. So my after-tax cost of funding is 7, inflation is 15, my real interest rate is -8. The bank is paying me to borrow because I get to pay them back in cheaper dollars. Whereas today, even with, say, a 4% mortgage, if inflation is only 1.5, which it is, That's a positive real rate of 2.5. So when I borrowed at 13%, the real rate was -5. Today, when you borrow at 4.5%, the real rate is +2 or 2.5. So nominal rates are at an all-time low, but real rates are very high. And that's what drives economic decision making, and that's what drives the economy. And one of the problems that economists and policymakers are wrestling with is how do you get real rates negative? Because that's what stimulates borrowing. If I think I can go borrow money and pay it back in cheaper dollars so that the real cost is negative, I actually get free money from the bank, or the bank pays me to borrow. That's what a negative interest rate means. That's supposed to be a prod or a stimulus to more investment, more R&D, and more consumption, and more economic activity and higher aggregate demand. The problem they're trying to solve is the following. We know from a long series of experiences, 30 or more business cycles since the end of World War II, that when the U.S. is in a recession, you have to cut interest rates 3 to 4% to get the U.S. out of a recession. You need 300 to 400 basis points of cuts to get the U.S. It's like a plane heading for the ground. How do you pull it out of a nosedive and get it back up in the sky? The answer is 300 basis points of cuts. How do you cut interest rates 300 basis points when you're only at 75 basis points? The answer is you can't. And forget about negative rates. The evidence is now pretty good that negative rates do not work. In other words, negative rates are not more of the same. When you go from, let's say, 0.5%, then you go to 1/4, and then you go to 0, and then you keep going to -25, you didn't just ease by another 25 basis points. The evidence from Japan and Europe is that you're through the looking glass and you have very strange effects, really unintended consequences. I'll give you a couple examples. So the conventional theory is, well, the more I cut interest rates, the more stimulus I get. That's a joke, but that's what they think. But if I go negative, you're absolutely going to go out and spend the money. Because if you don't spend the money, I'm going to take it away. You sit there long enough, you'll have nothing left in your bank account, because I'm going to take, with these negative interest rates, I'm going to take it away. So people will run out and spend. And the other thing is that, it's obviously, from the lending point of view, they'll borrow money, because the bank pays you to be a borrower. But here's what happens in the real world. This is the difference between academics and human beings. When people see negative interest rates, people have goals in mind. They have lifetime goals, right? They want kids' education, parents' health care, their own health care, retirement. If you start taking their money away with negative rates, guess what they do? They save more. They're like, hey, I got to put my kids through college. You're taking my money. Well, I better save more. And then what kind of signal is the central bank sending with negative interest rates? They're sending a deflationary signal. So people go, well, if you think it's going to be deflation, I'm not going to spend money. I'll wait till the price comes down. So you're trying to encourage lending and spending. And what you get is more savings and no spending, deferred spending. You get the exact opposite of what you want. So again, another egghead experiment gone awry. But the point being, so negative rates don't work. So zero bound really is zero. It really is a boundary. And Bernanke has said this in his recent writings, and I think he's right about that. So back to the problem. How do you cut interest rates 300 basis points when you're at 75? Well, the answer is you can't. So you have to raise them to 300 basis points. So the problem the Fed is trying to solve is how do they get rates to 3.25% before the next recession? Now, I'm not saying the Fed sees a recession, and that's easy because the Fed never sees a recession. In 102 years, the Fed has never seen a recession, never forecast a recession. But they know their economic history. We are 8 years into an expansion. It feels punk. I mean, the growth is anemic, but labor force participation is low, productivity is dropping. There are a lot of bad things going on, but in fact, we are in the 8th year, actually coming up on soon be entering the 9th year of an expansion, which began in June 2009. Right. By the way, you have a hard time convincing most Americans that we're not still in a recession. Depressions are different than recessions. The technical definition of a recession is 2 consecutive quarters of declining GDP with rising unemployment, a couple other bells and whistles, little subjective factors, but that's basically it. So people, when you say depression, they're like, depression sounds worse than a recession. And if recession is 2 quarters of declining GDP, then a depression must be like 10 quarters of declining GDP, because it's got to be worse. But that's not the definition. The definition of a depression, you can have growth in a depression, but it's below trend growth. In other words, if trend is 3.5, and you're actually banging out 1.5, 2, that gap between, let's say, 1.5 and 3.5% growth, that's depressed growth. It's an output gap. It compounds over time, and you never get it back. We are losing trillions of dollars of wealth. We are impoverishing future generations on a relative basis because of our inability to get back to trend growth. So the reason American people feel this and don't listen to the economists, and they're right, is because we're in a depression. So leaving that aside, the Fed at least understands the business cycle and the fact that the next recession, they say they don't die of old age, but they do die, and we're getting close to the next one. So they're in a desperate race to get rates up to 3.5% before the next recession hits, so they can cut them to get out of the recession. The question is, can you raise rates enough to cure the next recession without causing the recession you're preparing to cure? That's the dilemma. That's the finesse. My answer is no, they're not going to be able to do it, but they think they can. Why are they in this box? Well, because Bernanke should have raised rates in 2010, 2011, in the early stages of the expansion, when the economy would have been much better able to bear it than it is now. Bernanke skipped a whole cycle. He skipped a whole rate increase cycle to pursue these wacky experiments and, QE and zero interest rate policy and all that. I spoke to Bernanke about this, and he used the word experiment. He said this was an experiment. Bernanke made his academic reputation by studying the Great Depression, in the wake of Friedman and Anna Schwartz and some others. But he was a great scholar of the Great Depression, and he got his chance to kind of try out his theories. But what he told me was, he said 30 years from now, some new Ben Bernanke, some young scholar, will look back and tell us if we did a good job or not. We actually don't know right now. See, the Great Depression was really two technical recessions, 29 to 33, and then 1937, 38. But from 33 to 37, we had an expansion, but the whole thing was a depression because we never got out of it. The stock market recovered the 1929 high in 1954. It was a long time to get back to even. But Bernanke's mantra was, doing something is better than doing nothing. I completely disagree. It's better to do nothing if you don't know what you're doing. And this is really the monetary equivalent of the Hippocratic Oath. Doctors say, first rule of being a doctor is first do no harm. Anyway, bottom line is, by pursuing QE and zero interest rate policy, Bernanke failed to raise rates during the early stages of a cyclical expansion, which he should have done. If he had, the economy would have been just fine, and we'd be able to cut them today, but he didn't. So Janet Yellen now has to make up for lost time. So that's the mission. But again, and this is what the market completely does not get, and the Wall Street economists don't get. Nobody gets this, because they see the Fed raising rates, and they've done the correlations and the regressions back to World War II, and they go, every time the Fed raises rates, the economy is getting stronger. So if the Fed's raising rates, the economy must be getting stronger, so bid up stock prices, et cetera. But that's like saying umbrellas cause rain. Because they've got the causality backwards. The Fed never leads the economy, ever. The Fed follows the economy. So a normal business cycle looks like this. So you get a little expansion going, and unemployment starts to go down, and industrial capacity utilization starts to go up, and inflation starts to go up, and the Fed's watching, and then it keeps going. They go, it's getting a little hot. We better raise rates, and they raise rates, but of course they started too late. The expansion keeps going, inflation keeps going up, unemployment keeps going down. Then the economy starts to cool down, unemployment goes up, and then prices go down, and capacity utilization drops, and we get into recession. Like, we better cut. And then they cut, and then you hit the bottom, and then you come out of it again. So think of that as like a nice, pretty sine wave, right? That's a business expansion, business contraction over and over, 30 or so times since the end of World War II, with the Fed always following the economy, never leading the economy. So all the big brains on Wall Street, they've got all this data, and they say, well, every time the Fed raises rates, the economy is getting stronger. That has absolutely been true for like 30 times since the end of World War II. It is not true today. The reason it's not true today is because Bernanke skipped the cycle, and they're playing catch up. For the first time since 1937, the Fed is tightening into weakness. That is a key thing to bear in mind. The Fed is tightening into weakness. They are not leading the economy to strength. They are not responding to strength, even though Wall Street thinks they are. And there's a great danger that they're actually going to cause the recession they're preparing to cure, as I mentioned. The Fed will raise rates 25 basis points 4 times a year from now until the middle of 2019, until they get them to 3.25%. So like clockwork, every March, June, September, December, for 2017, 2018, into 2019, look for a Fed rate hike until they get to 3.25%, at which point they'll be able to say, all right, now we're 3.25. If we have a recession tomorrow, we can cut them back down to 0 again and get out of it. That'll be mission accomplished. Now, This is why I was sitting there in December like, yep, they're going to raise them in March. And right now, I'll tell your listeners they're going to raise them in June. There's your Fed response function. There's your baseline scenario. What are the exceptions to Fed rate hike? And under what conditions will they not raise rates? Because everything I just described to you, they've had in mind since March 2015 when Yellen took patience out of the statement. That was the end of forward guidance. And by the way, if you go back to 2015, I said they're not going to raise rates all year, and they weren't going to do the liftoff that people were looking for in March, June, September. And they didn't lift off in September because the Chinese rate, the exchange devaluation, the stock market fell out of bed August 2015. Finally, they raised them in December 2015. And Wall Street was ready for March. I said, no. In June, no. September, no. It wasn't until December 2016 that they raised them the second time. So obviously, there are conditions under which they don't raise rates, notwithstanding the baseline scenario. So what are those conditions? There are three. Well, four, actually. So if you see job creation below 75,000, that will cause them to pause. By the way, pause is the key word. If you go home through the speeches, you'll see the word pause in Dudley's recent remarks. Pause is the Fed's jargon for we're not going to raise rates. We got the Jim scenario, which I took from the Fed. It's their scenario. Or a technical recession. So, we're going to know Friday what the first quarter GDP is. It's pretty close to negative, but I'm not saying we're in a recession now. We might be. But if you see a recession, they'll pause. See job creation below 75,000, they'll pause. By the way, that's a very low bar. If you see a jobs report, see, this is the other thing that confuses Wall Street. You see a jobs report with 100,000 jobs. So Wall Street goes, oh, that report's really weak. The Fed's going to think twice. No, 75,000 is the number. Yellen told us that. It was in one of her speeches. You just have to be a geek like me and read all the speeches. So the third factor would be disinflation. So the Fed has this 2% inflation target. They've missed it for 6 years. They're finally getting close to hitting it. By the way, I think the listeners know they use the PCE core deflator year over year. There's PPI and CPI and core, a bunch of inflation indices, but we know what they use. PCE core deflator year over year. That actually has been getting close to 2%. But if you see it turn around, if you see that gap down to like 1.5, 1.4, 1.3, then they will pause. The last condition for the pause is a disorderly decline in stock markets more than 5%. If you see a 6, 7, 8% decline, so if the S&P went down 100 points, Fed doesn't care. Dow Jones goes down 1,000 points, Fed doesn't care. But beyond that, if you see the S&P start to go down 150 or the Dow start to go down 1,500 points, in a disorderly way. It looks a little scary. It looks like there's no bottom. It looks like if you see that, they'll pause. So the Fed's going to raise like clockwork 4 times a year for the next 2.5 years, unless you see job creation below 75,000, disinflation, a technical recession. If you don't see one of those things, they're going to raise rates. And so right now, I don't see any of them. I mean, they could all happen, but it looks like, growth is going to be positive. Job creation's been decent, over 100,000. Disinflation is probably coming, but not quite here yet, and they'll want to see a couple months in a row. And the stock market's not crashing. So none of the pause conditions are in place. Therefore, they will raise rates. Simple.